All right, asset analysis. So where do you start? Well, we're going to start with the metrics that are available in our system, and we'll walk you through them, why we picked them, and how they work. We're also going to walk you through the historical time periods, why that matters, and which historical time period actually works best for the different strategies. And then we'll get into beta, what that is and why that's important. Beta can be a great measuring stick when trying to understand what to expect between your portfolio's performance and the markets. Now, where are all these methods coming from? A lot of these are academic methods that are studied and taught in universities. These methods are common, but we wanted to find out what really worked. And in order to do that, we created a computer system that can analyze all of the stocks on the New York Stock Exchange and the NASDAQ. And from there, we created an automated portfolio construction method that helps us bring our testing process together. We began by testing a variety of questions over a time period from 2008 until 2020. And initially, we optimized our portfolios 4 times a year and built a separate portfolio for each of the different metrics. Then we tested the grades to see which ones performed best at identifying assets to include in the portfolios. Then those test results ultimately became the foundation for much of what we're walking you through throughout these lessons. And many of the academic claims about portfolio management, we feel were validated by our testing, which of course makes sense, but we'll get more into what those are. And there are some pretty interesting results that we're looking forward to sharing with you. And we'll cover all of the testing results with you in Portfolios 400. Getting into the different grading metrics, there were 11 different metrics that were originally tested. We're not going to get into what every single one of those were, but we arrived at 5 that we feel best represented different investment strategies. Since some of those metrics are fairly common and others a little less so, we're going to walk you through what each of them are, what they mean, and how to apply them. As you can see here, these are the test results for the different metrics, starting at the top with the expected return, then Sharpe's measure, Trainer's measure, alpha, and our overall average. And from left to right, you'll see how they performed over the different historical time periods. We tested 6 different time periods: 90 days, 1 year, 5 years, 8 years, 10 years, and 15 years. We wanted to see exactly how these metrics performed when we used them to select our assets and invest over a period of time. And as you can see, there are certain metrics that across the board tend to perform well, and there are others where you only want to pair them with certain historical time periods. My favorite metric for stock selection is Sharpe's measure, or Sharpe's ratio. And you can see here when you leverage that metric, you really want to use a 5 to 10 year history. And you'll notice that alpha is another one where you only want to use certain return time periods. And this time you'll want short term, like 1 year or 90 days. And then getting into the grade average, this is just an average of the stock's ranking in each of the other 4 metrics. We actually tested a variety of different mixes for this 5th metric, and the average of the other metric ranks actually performed the best overall. And we'll get more into all of them in Portfolios 200. This next chart shows the average return for each metric across all of the time periods. So looking here on the left, you've got the S&P 500, then the annual returns for expected return, Sharpe's measure, Trainer's measure, alpha, and then the overall average. Now, many of you might look at this chart and think, why would you ever choose anything other than expected return or Trainer's measure? And the reason why you wouldn't do that has a lot to do with beta, and we'll get more into that in a moment. The short version of the story is that you need to consider that the portfolio's asset selector is a computer, and it's going to make choices that most of us would not. And in our first attempt at this, it resulted in some questionable selections that did get lucky, but showed pretty dramatic variability. So as we adjusted our methods to take beta into consideration, we found that the results were a lot more believable, and the tools were also selecting assets that most of us would consider. So being able to stomach a portfolio with a high beta is not a badge of honor, so please don't go down that path. Like I said, Sharpe's measure is my favorite metric to use. It's just a very stable, consistent, and reliable metric for identifying good long-term investments. That said, each metric can offer advantages depending on the market and your timing. We'll get more into market timing and what we mean by that in Portfolios 500. Taking a closer look at historical time periods, you might say, well, why are you looking at 6 different time periods? And part of that goes back to me just asking a lot of questions and looking at a lot of the data that's out there, specifically stuff that's published by some of the others on the mainstream websites. And when I was trying to validate the math in the system, we found that a lot of the sites that are out there actually use 5-year histories for their metrics, which if you look at the returns, that may or may not be a good way to look at some of the metrics to use for stock selection. So what we found as we were working through this was that depending on the metric, the historical time period mattered and should really be considered when developing your strategy. So overall, in terms of just averages, we did find that for all of the metrics we included, that on average, the best performing historical time period is 10 years. When you use our technology, that's our default. Now, 10 years of history should work well for most of the measures, but depending on your strategy, you may want to consider making different selections. Okay, beta. A few moments ago, I mentioned that you may be interested in why expected return or trainer's measure might lead you down a path with a strategy that's a little bit more difficult to stomach. Essentially, what you need to understand is that for a lot of the assets that have high expected returns and trainer's measures, they're going to move a lot with the market, and beta is the measurement that will help you understand by how much. So if we look at this chart on the left here, this black line would represent an index like the S&P 500. So this is how that particular index would be moving over the course of that week. What you can see here is if you have a beta of 1, you have the orange line. Well, you can't even see the orange line because it's hidden behind the black line, which is the concept of a beta of 1, meaning that the stock is essentially just moving proportional to the index. Now, it's true that it won't look like this chart. Not every move every day will be aligned, but over time, the movements are going to be proportional to the index. So if you're looking at a stock with a beta of 2, for every gain or loss in the market, the gain or loss for that stock is essentially multiplied by a factor of 2. So what you're seeing with some of these assets that the computer selected, for example, were assets with betas of 4 or 5, and in some cases even higher. So you can just imagine if the market loses 2% in a day and you've got a beta of 5, well, you just lost 10%. Now, you could have gained 10% as well, but that's what I'm getting into about the volatility that beta can help you identify. So you really need to know how that works, because if you select a whole bunch of assets that have betas of 2, 3, 4, or 5, or even higher, then what you're going to have is a very highly volatile portfolio where you could gain or lose 10, 20, or even 30% in a day. And I don't know about you, but most people can't handle that kind of stress. So what you're looking for in your goal with beta should be to find assets that are close to or near 1, and that will provide you with a portfolio that moves a lot more like an index fund.